Hey trader, Stephen Quitzel here with tradersplan.com. It is Wednesday, March the 25th. Just going to look at the market real quick. And I'm doing these videos, and I'm probably going to do these videos, for at least another couple weeks. When I was a financial advisor, I thought the best time to communicate with your customers and your clients was, when the market was not doing so hot. So I think it's important, just kind of stay in front of you just to give you an idea of what my thoughts are. I'm going to look at a breadth chart real quick. This is the S&P Composite 1500 index with the S&P 500 in the small and the mid. Look at the market breadth. Right now, only 4% of stocks in this composite, 1500 stocks, are above their 200-day moving average. 4%. So if you're going to buy a company, I understand that you can get some bargain basement prices, but stocks can always go lower. Keep that in mind. So you better love the company, and if you're wrong, you better have a stop loss. If the market hits new lows, I would let your stop just get hit and just let the market hit new lows. But my point is, like right now, if 4% of stocks are above their 200-day moving average, at least in this index, why not, focus on stocks above their long-term moving average? Why not focus on the strongest 4%, instead of, the bottom 96%? Because those are stocks showing resilience. Yes, you can get some junk buying coming off the bottom with oil companies, with airline companies, with Carnival Cruise. Those companies are just getting taken out to the woodshed. But I think there's going to be a lot of pain for them for a very long time. So you can get some junk buying off the bottom, yes. But I seriously doubt that it's going to just, ride off into the sunset, and all happy sailing, pun intended. So, I would just kind of be cautious of this, focus on the strong, not the weak. This right here, this is a list of 237 ETFs. This is not every one under the sun, but I just kind of track to get a gauge. I always like to look at what's the strongest, what's the weakest. Yesterday oil was the strongest out of everything I track. I'm sure there are other ETFs that were probably up more, but it was up 17%. That's quite a bit. I don't know, where this is headed pre-market or anything like that. Yes, they could make quite a bit of move. Oil stocks could, but at the same time, again, this is an industry that is so far down. Most of the companies do not fundamentally look good right now. So if you want to, buy junk off the bottom, that's totally fine. And I am calling this junk, even though it could surge quite a bit. But I'm calling it junk because, fundamentally, some of these companies are going under. So if you're going to buy oil, I would definitely recommend an ETF because obviously the ETF can trade like a stock. You also have some miners that were gold. So when you have a day when the market's up a lot and gold miners are up even more, it's kind of not really what I want to see right there. So, but it is what it is. Now on the flip side, you have REITs that were down a lot. So this is really interesting, this real estate REIT right here, and there are probably some other ones that aren't as bad, but this just goes to show you it's got a 22% yield, by the way. I don't know if it's going to be able to keep that, but sometimes you have what's considered a conservative dividend ETF, and it just absolutely gets slaughtered. I mean, this was at 48, now it's at 16. So this is down well over 50%, maybe like 60, 65%. That's just an ETF, guys. So this is a very weak sector. Sure, if you want to look at this as a long-term opportunity, so be it. But I'd prefer to not buy weakness. I'd prefer to buy stocks that are holding up relatively well, like we talked about, that 4%. Let's look at the industries. This is more of just an industry ETF instead of sectors and countries and emerging markets, just individual industries, and you can see that the airlines was up the most yesterday. Again, you kind of have something that went from 32 to 11, so it got cut about 65%, and then it popped a lot yesterday. The Senate, Congress passed a bailout bill last night for $2 trillion. I don't know what's going to happen with this industry. I assume eventually it will come back, but again, I'd rather buy something that's kind of holding up relatively well, because I'm a little bit more conservative. So you have home constructions that was up quite a bit yesterday. It's a nice kind of little double surge above the 5-day moving average. I think that as long as the market doesn't roll over right here, you could see a lot of these. Probably, if we get a rally, I think it's going to rally up into the 20, which is quite a ways away. It's amazing how far some of these have fallen. You know, and then you got some gold, some oil that popped. But again, let me go look at the flip side. Let me look at a high dividend paying ETF. You have this MLP ETF that was, man, it's just been going down for a very, very long time. Was once at 13 and is now at 3. It's got a dividend yield of 24%. Don't know if that's going to hold. But, you know, it's down a lot, and it was the weakest of everything yesterday. Telecom is looking also kind of weak, although it looks like it's working on a reversal. So it's kind of interesting that some of the tech ETFs that have actually held up pretty well, you can see the rising relative strength line, didn't quite bounce yesterday. And even the list that I sent everybody out, I emailed this to everybody yesterday. I'll walk through some of these stocks. These are stocks, you know, kind of the Dominos, the Amazons, you know, the Zoom videos. These are companies that should hold up relatively well, or at least their earnings should during this, because a lot of schools are going to start Zoom video. You know, Domino's Pizzas is hiring, Amazon is hiring. Got all these companies that are hiring and should benefit from kind of the stay at home. It was very underwhelming yesterday. Most of the buying did not come in these, in my opinion, the fundamentally sound companies. They came from the airlines, the potential bailout companies. So I'm completely okay with that. I would much rather own this basket that I think that over, you know, if you look at today versus December 31st, I think this basket is going to do much better than a basket full of airlines and cruise ships and, you know, restaurant stocks and retail stocks and everything else that is just being taken out to the woodshed right now. So I think it's okay to own stocks, but I would own things, or at least, you know, probably trade new things that I think are going to do fundamentally well, unless you have an incredibly long-term view on anything. But like I say, that if you want to do a lot of bottom picking, let's say you like, you know, your favorite pet stock, you're getting it at a deep, deep discount. If you're getting it at a 50% discount, I just want to remind you, if it drops from 100 to 50, you buy it at 50 bucks, it can lose another 50%. That $50 stock can go down to $25. So just keep that in mind. I think that if you do some bottom picking, have a stop loss in place, and if the stock gets hit, so be it. So be it, okay? Because, you know, right now it's just all about risk reward. It's all about risk management. So I hope this was helpful. Domino's did do the best yesterday. And Zoom, actually the one that's been very, very strong, kind of did the worst. But it is up a little bit pre-market. So it was down 15%. So it was surged 20% in one day, but it's still holding that 5-day exponential moving average. I assume this is probably going to settle a little bit. But we'll just have to wait and see. I'll wait, you know, another day or two, and we'll go back through the list and see which ones held up.